Welcome to This Explainer. Today, we're going to unpack how a 103-year-old insurance giant actually balances its portfolio to maintain stability across all those crazy market cycles. We're diving right into Old Republic's newly released Q 2026 earnings to see exactly how they manage risk, navigate headwinds, and, consistently return value. So let's jump right in.
Okay, so here's our roadmap for today. First, a century of stability. Then, Q2 2026 by the numbers. After that, we'll go inside specialty insurance, check out the title insurance rebound, and finally, look at returning capital to shareholders.
Starting with Section 1, a century of stability, managing for the long run.
To really understand Old Republic, there's one fundamental principle you've got to grasp. They don't just manage quarter to quarter, they manage for the long run. Get this, 14%. That is their compound annual growth in book value per share, and yes, that includes dividends, over an astonishing 50-year period. I mean, half a century of steady, compounding growth. In the insurance world, finding that kind of consistency is just incredibly rare.
So how do they actually pull that off? Well, it's driven by what they call a low volatility model. This isn't about chasing the highest possible immediate returns, right? It's an absolute commitment to conservatism, deep diversification, and risk sharing. They strictly limit their exposure to property catastrophe events, think major hurricanes or wildfires, and instead rely on a really diverse product portfolio to keep things steady, rain or shine. Moving on to Section 2, Q 2026 by the numbers, consolidated results. All right, shifting from that 50-year macro view into the micro view of Q 2026, we see a slightly mixed picture on a consolidated basis. Net premiums and fees earned, those are up 5.2% to a very healthy $2.1 billion, showing that the growth engine is definitely still running. But operating earnings per share dipped 9.3% to 76 cents. And on top of that, their combined ratio, which is how we measure underwriting profitability, crept up 1.7 points to 95.3%. Now, what's really interesting here is that this dynamic sets up a true balancing act between their two core divisions.
See, Old Republic is basically balancing two completely opposite business models under one roof. It's like a giant seesaw. On one side, you've got specialty insurance. It's capital heavy, features high loss but low expense ratios, and is heavily influenced by the wider property and casualty market cycle. But on the other side, there's title insurance. This one is capital light, has low loss but high expense ratios, and is tied strictly to real estate cycles. This stark contrast right here is the secret sauce to their stability, because when one side faces headwinds, the other side often catches a tailwind.
Let's dive into Section 3, inside specialty insurance, focusing on resilience in P&C.
Digging into this specialty insurance segment, we're looking at a highly diverse product portfolio. Orensco takes the biggest slice, at nearly 39%, followed by specialized lines like inland marine and general liability. But despite all this diversification, the segment definitely faced some pressure in Q2, posting a 21.7% decrease in pre-tax operating income. So, what was the primary reason? Well, it was unfavorable prior year reserve development. Basically, they had to set aside extra funds for past claims that just ended up costing more than expected, and they combined that with some heavy investments in technology and newly acquired companies. So, how exactly do they mitigate those inevitable dips? They actually build a powerful shock absorber right into their products, using what are called loss-sensitive structures. This means they use tools like captives, large deductibles, and retrospectively rated programs. Essentially, these are arrangements where customers self-insure a portion of the risk. In fact, a massive 72% of their workers' compensation premium is loss-sensitive, and because customers are actually sharing in the underwriting risk, their financial incentives are perfectly aligned with Old Republic's. The result? A staggering 90+% customer retention rate, which pretty much ensures consistent growth even when a single quarter gets a little bumpy.
All right, Section 4, the title insurance rebound, balancing the scale. Moving to the other side of that seesaw we talked about, we can see exactly how the title insurance segment stepped up to counterbalance the specialty segment's dip this quarter. Net premiums earned are up a solid 11%, nearing $700 million. But here is the crucial point. Just look at the bottom line. We're talking about a massive 130.5% surge in pre-tax operating income, jumping from $24.2 million last year to $55.9 million this quarter. Talk about a comeback. This is exactly the counterweight the consolidated business needed.
Now, you might be wondering, how did they pull off such an incredible rebound in a notoriously tricky real estate market? It really boils down to two key factors. First, they've got a highly profitable commercial premium mix, which now makes up over a quarter of their net premiums earned. And second, significantly improved expense management. You see, during the same period last year, they were bogged down dealing with heavy, one-off litigation settlement expenses. But with all of that in the rearview mirror now, the true operational scale and efficiency of this segment is really getting to shine through.
Which brings us to Section 5, Returning Capital to Shareholders, the Long-Term Reward.
Pulling the narrative back out to the macro level for a second, what does this beautifully balanced portfolio actually mean for the folks invested in the company? Well, before we talk dollars, let's consider the philosophy driving those dollars. It's about operating a diverse and decentralized portfolio, fostering a culture of integrity and accountability, rigorously aligning incentives to drive profitable growth, and maintaining a remarkably lean organizational structure. Their Q2 results, they aren't just an accident. They're a direct reflection of this long-term playbook in action.
And here's the immediate reward for all that discipline. In the second quarter alone, Old Republic returned a staggering $137.4 million directly to shareholders through a combo of regular dividends and share repurchases. That steady return of capital pushed their book value per share up 7.2% from year-end, landing at an impressive $25.33. That right there is the low volatility model paying off in real time.
But, managing for the long run doesn't just mean playing defense or handing out dividends. It also means strategically growing today so you can secure tomorrow. Just after the Q2 quarter closed, they completed the strategic acquisition of Everett Cash Mutual Insurance Company. This tactical addition is expected to be immediately accretive to their 2026 earnings, proving that they're still out there actively expanding their specialty insurance footprint to capture even more market share. So that brings us to the ultimate question, and it's something I really want you to think about. How does a century of disciplined, low-volatility risk management prepare a portfolio to outlast the next 100 years of market cycles? If Old Republic's Q2 26 tells us anything, it's that true stability isn't about avoiding the storm. It's about building a business with enough counterweights to sail right through it smoothly. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.